Good morning. Hope you're doing well today. So, in our conversation previously, we talked about facility financing. Today, we are talking about budgeting. So, here we go. This is chapter 5, part 2. Budget planning is always a speculation, regardless of how much research you do ahead of time. Something may happen last minute that will save you some cash or drive up your costs. But either way, planning allows you to estimate to the best of your ability what you can expect to spend, and a good budget planner will always be able to anticipate variables in spending more accurately. When it comes to budgeting for your FF&E, which is furniture, fixtures, and equipment, there are many factors in play. You want to maintain a certain aesthetic for your facility, and you want to offer your client an experience of your facility that lets them know you care. But sporting facilities, like other hospitality businesses, require a large amount of equipment, resulting in hefty FF&E budgets. Some sources suggest budgeting by space, meaning that you budget your FF&E costs by the square footage of your facility. These sources say that per square foot you can expect to pay anywhere from $9 to $12. Think about the density of equipment in each area of your facility, where your reception area may be relatively open, containing some chairs and tables. Computers and other electronics. Other areas like a weight room or cardio room will have a much greater concentration of equipment. Using an average figure and estimating per square foot can be a reasonable way to build your budget, but some finer details may dramatically skew your cost. Your FF&E reserves. A significant part of budgeting for FF&E hinges on the way that the value of your equipment will decrease over time, and what you can expect to pay back to make back if you need to liquidate it. So, if you have the room in your initial budget for nicer equipment, you won't have to put in as much in your reserves for the first few years, because that equipment should hold up pretty well. Generally, however, it's a good idea to set a bit of your budget aside once you've purchased equipment to have available for repairs or replacements. With a budget, you will be able to manage cash flow, which is one of the most challenging aspects of being a business owner. Learning to budget can help you overcome this challenge. Without a budget or plan, your facility or club runs the risk of spending more money than it is taking in, or conversely, not spending enough money to grow the business and compete. Putting together a budget requires guesswork, time, and focus. Failure to have a comprehensive plan will inevitably stunt your business growth. For example, as your business grows, you may want to consider software to help with managing the business. But if you fail to factor in things like finances adequately, the help will be futile. It empowers you to make smart financial decisions. You can use it to see where your business finances stand right now and what you need to do to achieve your financial goals in the future. Think of it like your baseline. It helps you assess where to minimize spending or grow revenue. Having a business budget can help you identify areas in which you can decrease your spending or increase your revenue, thus increasing your profitability. It enables you to secure funding to grow your business. A detailed budget outlining your income and expenses is required if you plan to apply for a business loan or to raise capital from investors. Compile all necessary information to include in your budget. A budget for your business may be one of the most important accounting tools you'll use. Ensure all information gathered is accurate and up to date. The three main areas to focus on are as follows. Revenue. This data comes from sales, your registrations, lesson fees, rentals, etc. Accounts receivable. These are future payments like team payment plans, memberships, etc. Interest and other sources. Cost of goods sold. This data is the direct cost of items like tournament entry fees, vending machine items, or uniforms. And then operating expenses. These are typically recurring expenses like payroll, rent, and software fees. The hard work is not in creating a budget, but maintaining it. To maintain an effective budget, you should refer to it at regular and frequent intervals, making changes based on what you learn. And always remember, the key for any budget is being realistic in your projections of revenue. A line item budget is one in which the individual financial statement items are grouped by category, much like what you see here in the picture. It shows the comparison between the financial data for the past accounting or budgeting periods and estimated figures for the current or future period. A line item budget is one approach to helping a business develop a financial plan. Establishing and implementing a budget is crucial to running a successful business. Several small and average-sized businesses utilize line item budgets because they are simple to do and fast to build. A line item budget is a method used while creating and monitoring financial spending. Items are grouped by departments or costs to show which areas are using the bulk of the company's funds. The line items show specific financial data for accounting purposes, but it's typically only used for expense reporting. It can show comparisons of financial information during past, present, and future economic periods. The line budgeting item will help business comprehend whether their income funds are capable of covering expenses. Companies can easily see whether a single item will exceed or come under budget. For example, if a business notices a particular product they use impacts the balanced budget, they can pay close attention to that item and monitor trends to see if it affects the budget over time. When creating a line item budget, you can use a group titled expenses. Gather comparable uses into groups like office materials, employee compensation, professional development, marketing, and advertising. Each category should be on its own isolated line within the expenses. Line item budgets offer many advantages for businesses, especially since you don't need to have a financial background to understand how to use and read them. Line item budgeting offers decision makers an easy and guided approach to budgeting. Budget decision makers can utilize a line item budget to form specific financial choices, such as changing funding levels based on the supply money for running the business successfully, or by making costs to cut based on changes in budgeting or organizational policies. An operating budget is a detailed projection of what a company expects its revenue and expenses will be over a period of time. Companies usually formulate an operating budget near the end of the year to show expected activity during the following year. An operating budget helps organizations set and achieve business goals. Each month or quarter, managers can compare actual results to the operating budget and analyze the outcomes, such as questions are sales more or less than projected? Were there unexpected expenses? Do figures for the rest of the year need to be adjusted? Analyzing the results can help companies adapt to changing conditions, update their actions and strategies if necessary, and achieve better performance. The more detailed an operating budget is, the more relevant and valuable it becomes. An operating budget may include a high-level summary along with several supporting sub-budgets that provide greater detail. Here are the common components of an operating budget. Revenue. This includes all the different ways a company makes money by selling goods or services. Projected revenue can be based on a simple year-over-year forecast, but breaking revenue down into its variable components such as unit volume and average price can yield greater insights. Variable costs. These are costs that rise or fall in lockstep with sales volume. Examples include expenses for raw materials, labor, freight, and sales commissions. Your fixed costs are expenses that remain fairly constant. They have to be paid whether sales are up or down. And examples include your rent, utilities, equipment leases, and insurance. Then your non-cash expenses. Some of these are included depreciation of your equipment, amortization, and unrealized gains or losses, your stock-based compensation, and deferred income taxes. Your non-operating expenses are costs that are not directly related to a business's main activity. The most common non-operating expenses include your interest payments on a loan, losses on the disposition of assets, and costs from currency exchanges. Some industries or organizations may include other items in their operating budgets. However, capital expenses are not ordinarily part of an operating budget because they are long-term costs, and an operating budget is a short-term budget. Creating an operating budget is a collaborative effort involving executives and managers. First, they must estimate the coming year's revenue. This involves checking the firm's historical performance and then considering market variables that could affect next year's sales for better or worse. Among them are changing trends in the industry or sector, new products the company will launch, the competitors' actions, seasonal changes in sales, and changes in the economy. Next, executive and managers must estimate projected expenses for each part of the business. Managers can account for their own departments. For example, HR's budget might include recruiting expenses, changing benefit costs, the cost of replacing the department's aging laptops, and a host of other outlays. The CFO or Chief Financial Officer and other executives may be in the best position to tally projected expenses that affect the entire company, such as rent and taxes. As with revenue estimates, considering historical data and market variables can help build sound expense estimates. Gathering all the needed figures can be a big job for all but the smallest organizations, but it's essential for creating an accurate operating budget and enjoying the clarity and guidance this document will provide. An incremental budget is a budget that is prepared by taking the current period's budget or actual performance and using it as a base and then adjusting it by incremental amounts. This is typically accomplished by taking the prior year's budget and adjusting for some increase in costs. Your incremental budgeting is a type of budgeting process that is based on the idea that a new budget can best be developed by making only marginal changes to the current budget. In other words, with incremental budgeting, the current budget is used as a base to which incremental assumptions are added or subtracted from the base amounts to determine new budget amounts. Among all budgeting methods, incremental budgeting is commonly considered as the most conservative approach. Some advantages to incremental budgeting are that it can be appealing to companies for a number of reasons, including simplicity. Incremental budgeting is the easiest budgeting approach since it is using the budget for the current period to project the future budget. It does not require complex calculations. Also, only a few assumptions are required in the budgeting method. Finally, the method's simplicity allows the company's management to save time on the budgeting process. Consistency and operational stability. The dependence on the figures from the budgets of previous periods ensures that the budgets remain fairly consistent and relatively stable over time. It also provides funding stability. Your incremental budgeting may also ensure that funding remains stable over time as expenses are relatively easy to project. This can be helpful for companies with projects that require funding for multiple years. It reduces internal rivalry. Incremental budgeting generally allocates equal incremental changes to the budget from one year to the next. Thus, departments within a company are not forced into a position of competing with each other to obtain a larger portion of the budget. Some disadvantages: despite its simplicity and consistency, incremental budgeting is frequently criticized for a number of underlying flaws. The primary potential disadvantage of such are that it promotes unnecessary spending. Incremental budgeting can result in unnecessary spending for a company. The reason behind this is that the departments within a company generally tend to spend all the money that they have that they've been allocated in a budget one year in order to obtain a greater amount of money in the next budgeting period. Incremental budgeting takes the position of increasing each part of the budget by a certain amount each year. However, some departments may not, in fact, need more money each year, but they will be allotted an increase anyway, simply because that's how the budgeting process works. In this way, the budgeting process may be wasteful and less than optimally efficient. It discourages innovation. This type of budgeting may discourage the production of innovative ideas and growth. Since new budgets are based on figures from previous budget, there is less room for the financing of completely new ideas or activities. Thus, the budgeting process discourages the implementation of new ideas and fosters a conservative business environment. it fails to account for changes in external factors. The key assumption behind incremental budgets is the constant stability of the company's operations. Therefore, the budgets are typically not responsive to potential changes that can result from unforeseen circumstances or some unanticipated factors. It lacks an incentive for a comprehensive review. The stability of incremental budgets does not provide any incentives to the company's management for reviewing its budgets with a view to realizing savings and expenditures. The lack of a review process makes budgets vulnerable to waste, inadequate assumptions, and mistakes. The bottom line is simplicity and consistency are the primary advantages of incremental budgeting. However, this budgeting technique can lead to adverse effects in the long term. The conservatism of this budgeting method, as well as its inflexibility and resulting inability to adjust to internal and external changes, imposes potentially problematic limitations on companies operating in today's fast-paced business environment. Generally, incremental budgeting is best applied only if you are confident that the company's budgets will remain stable in the long term, with only minimal changes. In other cases, it is recommended to use more sophisticated budgeting techniques. Zero-based budgeting is a budgeting technique that allows funding based on efficiency and necessity rather than budget history. Management starts from scratch and develops a budget that only includes operations and expenses essential to running the business. There are no expenses that are automatically added to the budget. All expenses must be justified in order to qualify to be placed in the budget. For example, if a company expects to incur $100,000 in salaries and wages expenses and believes that the full $100,000 is necessary to operate the business smoothly, then it will be included in the budget. However, each individual allotment of salary wages has to be examined and justified in order to be included. If instead of paying some salaries, the company's management determines that it can substitute technology at a lower cost, then adjustments to the budget are made accordingly. All businesses use budgets to keep track of spending and improve ways to minimize costs and maximize profit. Budget planning for the current and next year is usually based on budgets from previous years. In fact, traditional budgeting often begins with the previous year's budget and usually implements incremental percentages, increases or decreases to meet new goals. These percentages usually range anywhere from 1 to 10%. Sometimes budgets can get out of control, or in some years they may show significantly higher or lower costs depending on the overall market outlook and other external factors. In such scenarios, it does not make sense to look at last year's budget because significant changes in the company's situation have taken place. The entire budget needs to be redone from scratch, hence a zero-based budget. In a zero-based budget, the company analyzes every expense aspect of the business one by one. This is referred to as starting from a zero base. While zero-based budgeting examines all expenses, traditional budgeting only examines proposed new expenses. Some advantages of zero-based budgeting: the final output is well justified and is aligned with the company's overall business strategy or plan. It encourages more collaboration throughout the company and improves performance and operating efficiency by challenging assumptions and examining expenditures. By avoiding traditional budgeting percentage increases, there is significantly better chance of making cost reductions. Some disadvantages are that implementing a zero-based budget requires qualified personnel and specialized training, which can be time-consuming and costly. It may harm the company's overall culture or brand image, and may be cost prohibitive because of time, research, and analysis required for companies with minimal available funding. It is substantially more complex and tedious to start from a zero base. Traditional budgeting is much simpler, faster, and easier to implement. Finally, to sum it up, all zero-based budgeting is an option that can create numerous benefits. There are also some potential drawbacks. Implementing zero-based budgeting is not only an accounting decision and must be considered in conjunction with the company's overall business strategy and goals. While a zero-based budget may help companies better reduce costs, they may completely change the value of the company and its culture. For example, if companies rely heavily on maintaining a positive, vibrant, and accessible environment for their employees, but all the expenses to maintain this environment were eliminated due to the zero-based budget process, the company's overall culture may change. This change may lead to higher turnover rates and negative changes in brand perception. Variance analysis can be summarized as an analysis of the difference between planned and actual numbers. The sum of all variance gives a picture of the overall overperformance or underperformance for a particular reporting period. For each item, companies assess their favorability by comparing actual cost to standard cost in the industry. For example, if the actual cost is lower than the standard cost for raw materials, assuming the same volume of material, it would lead to a favorable price variance or cost savings. However, if the standard quantity of 10,000 pieces of material and 15,000 pieces were required in production, this would be an unfavorable quantity variance because most materials were used than anticipated. When standards are compared to actual performance numbers, this difference is what we call a variance. Variances are computed for both the price and quantity of materials, labor, and variable overhead, and are reported to management. However, not all variances are important. Management should only pay attention to those that are unusual or particularly significant. Often, by analyzing these variances, companies are able to use the information to identify a problem so that it can be fixed, or simply to improve overall company performance. The types of variances, as mentioned above, are materials, labor, and variable overhead consist of price and quantity and efficiency variances. Fixed overhead, however, includes a volume variance and a budget variance. Charity sport events provide participants with a meaningful event experience, and the opportunity to support a charitable cause is a critical component of this experience. This opportunity often involves fundraising, either as a requirement of event participation or as an option to supplement registration. However, fundraising as part of charity sport event participation is a difficult task. Charity sport events are important vehicles for charitable organizations, as these events are not only an opportunity to promote active and healthy lifestyles, but also a mechanism for charities to raise funds and promote their brand. Fundraising on behalf of a charity has become a critical component of a number of large-scale participatory sport events, such as the Nike Women's Marathon and Tough Mudder, and is central to the charity sport event experience. A charity sport event is a participatory sport event that generates funds for a specific charitable cause from participants in exchange for their opportunity to participate in the event. And here you see the event organizers, which are typically the nonprofit organization, produces the event, and participants raise awareness and money for the nonprofit organizations through a combination of either their own contribution and or peer-to-peer fundraising. And there is typically a financial commitment required of participants. A lot of that's going to vary depending upon the event. It will be a free entry. Others, you pay $10, $20, or more, depending upon the event and what all is required, what things go in the goodie bag for the participant. And these are my references for both the financing and the budgeting lecture. So hope you have a great day. I look forward to talking with you soon.